Okay, let's talk about our financial statements just a little bit. We're going to expand upon what we've already learned. So far we've learned a basic single-step income statement. And what that basically has consisted of are our revenues minus our expenses. And that gave us our net income. So here's a general basic single-step income statement is what we call it. Take your net sales minus our cost of goods sold and operating expenses. So our total expenses here were $304,600. Revenues minus expenses gives us net income of $12,200. Now we're going to expand upon that, and we're going to do something now called a multiple step income statement. It's going to give us more information. It's a bit more detailed, so we can make better conclusions or draw more conclusions from the information that's provided. So we're going to add sections for other types of revenue and gains. So for example, we may have sales revenue, interest revenue. Those would be two different categories. We'll go ahead and add that instead of lumping them all together. We may have categories for other types of expenses or losses. And then typically we'll separate our operating expenses, which are our everyday business activities, into what are called selling and administrative expenses. You may also see it referred to as SG&A expenses, which is your selling, general, and administrative expenses. With our multiple step income statement, we're going to include a calculation of gross profit, and then we may have the other sections for non-operating. So we have other types of expenses that are not from our everyday business activities. We may go ahead and add that in as well. So remember how we calculate gross profit. Take your net sales minus cost of goods sold gives you gross profit. And again, net sales are your actual sales minus any sales discounts minus sales returns and allowances. And then we take our gross profit minus our operating expenses to get in that income. So here's an example of a, it's not important. Here's an example of a multiple step income statement. We've got the company name, start with our header, income statement for the year ended December 31st. Take sales minus sales discounts minus sales returns and allowances to get our net sales. Remember, that's where we start with most of our sales calculations. So the company sold $323,800 worth of product, but after we had sales discounts and sales returns, it came out to $317,500. The cost of goods sold on that was $233,200, so the gross profit is $84,300. This is what the company now has left to pay all of their other expenses and to hopefully generate some net income along the way too. So you can see now we've set up in our operating expenses selling, general, and administrative. So we separated those two categories. We can see what expenses are associated with selling the merchandise versus what expenses are associated with, for example, home office expenses, accounting, human resources, attorneys, and all of those other associated expenses. So our total operating expenses were $71,400. Gross profit minus total operating expenses gives us net income. We also can do the same thing with our balance sheet, so we can blow that up. And you should be pretty well prepared for this because we've been talking about it since day one. So instead of just taking assets, liabilities, and equity, we're going to break those classifications into current and long-term, which you can see here, current, long-term, and then some other categories we'll add in there as well. So let's talk about each and every one of those categories in a little bit more detail. So current assets are going to be cash and other resources that are expected to be used or consumed within 1 year. Here's something important to note here. So current assets are typically listed in the order of liquidity, and that always starts with cash because cash is the most liquid asset. It's always already in cash. Then typically, depending on the company, they'll list out accounts receivable, maybe inventory, and then you get into supplies, the prepaids, and on down the line. So examples of current assets are going to be inventory, accounts receivable, cash, supplies, prepaid rent, prepaid insurance. Then we have long-term investments. So those are not expected to be converted into cash within the year. So we expect to hold them longer than 1 year. Examples of that might be investments in land, investments in other companies, so stocks and bonds in other companies. Property, plant, and equipment is also a big category of our long-term assets. You may hear that referred to also as PP&E, your property, plant, and equipment, PP&E. Those are land, buildings, and machinery. They last obviously longer than 1 period. Intangible assets are assets that don't have any physical substance. You can see their patents, copyrights, trademarks are all included under the intangible assets section. Then if we move to liabilities, we have current liabilities. Those are expected to be paid within the current year. Examples of those would be accounts payable, wages payable, interest payable, and any current portion, current maturities of long-term debt. So any portion of long-term debt that's going to be due within the current year would fall under this category. Long-term liabilities are those outside of the current year, and it's very important that we separate liabilities into current and long-term because we need to know how much we have to pay our bills as they come due. So we need to be able to say, oh, I'm going to have these expenses coming up. I need to plan and allocate and make sure I have enough resources to pay those as they come in. And then our equity section looks pretty much the same that we've been looking at before. The only differences might be if we have a sole proprietor, that will fall under the owner's name, comma, capital instead of common stock. You may also see the word capital stock. I tend to use common stock, but capital stock is the same thing, and that will be for corporations. Partnerships will have multiple capital accounts, and then we still have our retained earnings. So here's an example of a classified balance sheet. Again, we always start with the header, which was the company's name, balance sheet, and then the date. Remember, balance sheet is as of a specific date. Here's a snapshot of what our assets, liabilities, and equity are. So we'll list out our current assets, cash, accounts receivable, supplies, prepaid insurance. So total current assets are $16,950. Then we have our property, plant, and equipment, which is long-term. Office equipment less accumulated depreciation. We'll get into depreciation a little bit more in a few weeks. So the cost minus accumulated depreciation gives us book value, and our total assets are $21,910. Now remember, liabilities plus equity have to equal $21,910, or we made a mistake, and they do here in this case. Now we can see our current liabilities: notes payable, accounts payable, interest payable, unearned revenue, which is a liability, and salaries payable. So my current liabilities, those due within the current year, are going to be $1,200. Oh, looks like my lines are all goofed up. $5,550 is what that should be. Then I have long-term notes payable, $4,000. If I add those two together, I get total liabilities $9,550. Retained earnings of $12,360, so my total liabilities plus owner's equity is $910.